Most of the money in the world didn't exist 5 years ago. Some of it didn't exist last week. And almost none of it is physical. Right now, sitting in bank accounts, moving through digital transactions, powering entire economies, it's mostly numbers. Entries in a database. And here's the part that should stop you cold: a huge portion of that money was created the moment someone took out a loan. So if money can just appear, why aren't we all rich? I'm Momo, and today we're breaking down one of the biggest systems shaping your life, where money actually comes from.
Mind's on the move and the world's in my hand. Momo's got the stories that you gotta understand. From trends to the news, we're keeping it tight. Mind over Momo, we're learning it right.
Stay sharp, stay bold, let your mind be free. Momo's got the scoop for the next big key. Hit like, hit sub, let the good vibes grow. Mind over Momo, now you're in the know. Mind over Momo.
You've probably noticed something feels off. Groceries cost more. Rent costs more. The salary your parents thought was comfortable in 1995 barely covers rent in a studio apartment today. And every time you ask why, someone says the same thing: inflation. Prices went up. Companies got greedy. The government printed too much money during the pandemic. And those things aren't wrong, exactly. But they're not the full picture. Here's the real question nobody asks out loud: who actually creates money, and why does creating more of it make everything you own worth less? Most people assume governments print money when the economy needs it, and that more money means more wealth. That seems logical. If a country has more dollars, the country is richer, right? Here's where it gets interesting, because you've probably participated in this system without realizing it. If you've ever had a bank account, taken out a student loan, financed a car, or even used a credit card, you've been part of the money creation process. Not as a bystander, as a mechanism. And once you see how it works, you can't unsee it. Let's start with what most people think they know. The story goes like this: the government collects taxes, spends money on roads and schools and armies, and when it needs more, it tells the central bank, in the US, that's the Federal Reserve, to create more money. The central bank prints bills, coins get minted, and that money flows into the economy. Simple. Clean. And that process does exist. But it describes a tiny fraction of the money supply. Here's the part most people miss: most money in modern economies is not created by governments. It's created by commercial banks. The banks you deposit your paycheck into. The banks that issue your mortgage. The banks that process your card when you buy lunch. Here's how it actually works. When you deposit $100 into a bank, that bank doesn't just hold your money and wait. Under a system called fractional reserve banking, the bank is only required to keep a fraction of that deposit on hand, say, 10%. The other $90, the bank can lend out to someone else right now. But here's the part that breaks people's brains: that $90 doesn't come from somewhere else. The bank doesn't take it from another account. It creates a new deposit. New money. Digitally. Instantly. And then that borrower deposits their loan into their bank, which lends out 90% of that, which gets deposited somewhere else, which gets lent out again. $100 walks into a bank. Several $100 in new deposits can walk out the other side. This is called the money multiplier effect, and it's how modern banking actually functions. So the next time you hear, "the bank approved my loan," understand what that really means. The bank didn't hand you money it had sitting in a vault. In a very real sense, it created that money when it approved the loan. And your promise to pay it back, with interest, is what gives that new money its value. This is not a conspiracy theory. This is standard monetary economics. The Bank of England published a paper in 2014 that said it directly, whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. Most people have never read that sentence. Most people were never taught it. Now here's where the system gets even stranger. So we've established that banks create money through loans. Fine. But why does that make your money worth less over time? Think of it this way. Imagine the entire economy is a pie. That pie represents every real thing of value, every house, every loaf of bread, every hour of labor, every product on a shelf. Now imagine the money supply is a set of tickets. Each ticket represents a claim on a slice of that pie. If you double the number of tickets but the pie stays the same size, each ticket is worth half as much. That's inflation. Not prices going up arbitrarily, the value of each dollar going down because there are more dollars chasing the same amount of real stuff. And this is exactly what happens when banks create money through lending at a scale far beyond what the real economy is producing. More money enters the system before more goods and services exist to absorb it. The gap between money and value widens. Prices rise. Your savings, sitting quietly in an account earning almost no interest, buy less every year. But let's go one level deeper. Because it's not just banks. Governments borrow money too. When a government spends more than it collects in taxes, it issues bonds, basically IOUs. Central banks can buy those bonds, which injects more money into the financial system. This is called quantitative easing, and it became a household phrase after 2008 and again after 2020. During the COVID-19 pandemic, the US Federal Reserve expanded its balance sheet by trillions of dollars in a matter of months. The European Central Bank did the same. That money flooded into the system. And within 2 years, inflation in many developed countries hit 40-year highs. Was that the only cause of that inflation? No. Supply chains broke down. Energy prices spiked. But the monetary expansion accelerated and amplified everything. Here's what this means for you directly. When the money supply grows faster than real economic output, the people who feel it hardest are the ones holding cash and wages. Because cash loses value. Wages are slow to adjust. But assets, houses, stocks, commodities, tend to rise with the money supply. So who benefits when money is created? Generally, people who own assets. People who borrowed early, at low interest rates, and locked in prices before inflation hit. People with wealth that moves with the money supply. Who get squeezed. People whose savings sit in cash. People earning salaries that don't keep pace. People who are trying to buy assets at the new, inflated prices. That's not a coincidence. It's a design feature of the system, not necessarily intentional cruelty, but a structural outcome of how money creation actually works. Let's zoom out for a second. This isn't just an economics lesson. It's a lens for understanding almost everything about modern society that feels broken. Why does every generation feel poorer than the last, even when GDP numbers keep going up? Because GDP measures the size of the economic pie in dollars, and if the dollars themselves are worth less, the number can grow while the real slice shrinks. Why do central banks obsess over interest rates? Because interest rates are the main lever they have to control how fast money gets created through lending. Higher rates make borrowing more expensive. Less borrowing means less money creation. Less money creation slows inflation. It's the volume dial on the whole system. Why did housing become completely unaffordable for young people in most major cities? Partly because decades of low interest rates made borrowing cheap, which pumped enormous amounts of new money into real estate specifically, turning homes from places to live into financial assets. Pull this thread, and it connects to student debt. to wage stagnation, to the growing gap between asset owners and everyone else. The money system isn't just background noise. It's the architecture that shapes who gets ahead and who falls behind. Understanding this doesn't make you powerless. It makes you clear-eyed. You can start asking better questions about the economy, about policy, about where your money actually is and what it's actually doing. Here's the one thing I want you to leave with today: inflation is not just prices going up. It's a symptom of a system where money can be created faster than the real value it's supposed to represent. And the people who understand that system, who know how money moves, where it comes from, and what erodes it, those people make very different decisions than everyone else. Now here's what I want you to think about before the next episode. If money keeps multiplying faster than real wages, if the system keeps expanding the supply of dollars while the supply of affordable housing, affordable education, and real wealth stays locked away, why does it feel like every generation is working harder just to stay in the same place? Next time, we're going to break down exactly that. Housing inflation. The student debt machine. Why middle-class wealth building worked completely differently before the 1980s. And what actually changed? Because once you understand where money comes from, the next question is obvious: where is it going, and why isn't it going to you? Think deeper. The system's bigger.
Mind's on the move and the world's in my hand. Momo's got the stories that you gotta understand. From trends to the news, we're keeping it tight. Mind over Momo, we're learning it right.
Stay sharp, stay bold, let your mind be free. Momo's got the scoop for the next big key. Hit like, hit sub, let the good vibes grow. Mind over Momo, now you're in the know. Mind over Momo.